In 1929, the bottom fell out of the American stock market. What followed was the Great Depression, an 89% plunge in equities over 3 punishing years. 1 in 4 workers jobless, banks collapsing, and life savings evaporating. It took a full quarter-century before markets clawed their way back to the levels seen before the crash. Fast forward to 2008. This time it was housing that detonated. The Great Recession carved 57% off the stock market in just 18 months. Unemployment doubled into double digits, and retirement accounts were shredded. It still took 5 long years for the system to recover. But 2025 is not a repeat of either of those eras. It's something fundamentally more dangerous. Today, stocks, bonds, and real estate, assets that historically move in opposite directions, are tumbling at the same time. Historians are calling it the everything bubble. And when everything pops together, there's nowhere to shelter. Think of it this way. We aren't living through 1929. We're living through 1928. The moment right before the cliff. Only this time, the lifelines that rescued us in 1929 and again in 2008 are already stretched to their breaking point. The Federal Reserve can't slash interest rates to 0. They're already relatively low. It can't unleash unlimited money printing. It tried that, and we got the worst inflation in 4 decades. And Washington can't simply write blank checks. The government is buried under $36 trillion in debt. Every major warning light is blinking red. The window experts point to, November 2025 through June 2026, isn't arbitrary. It's based on cold arithmetic. To understand why this moment is so unique, you have to see the structure of the crisis. This isn't one bubble. It's 3. And they've never formed simultaneously before. First, the stock market. The S&P 500 is trading at a price-to-earnings ratio near 28, almost double its long-term average of roughly 15 to 17. Only twice before have valuations stretched this far. In 1929, before the Great Depression, and in 2000, ahead of the dot-com implosion. Both times, the crash struck within months. But this time, the risk is concentrated in a handful of giants. 7 companies: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla make up about 30% of the entire S&P 500's value. If even a couple of them stumble, the whole index shudders. Nothing this top-heavy has existed since the late 1920s, when a few industrial giants propped up the market before everything unraveled. Nvidia demonstrates the absurdity of today's valuations. Its price-to-earnings ratio sits above 65. Investors are paying $65 for every $1 of profit. The company's market cap has soared past $3 trillion, larger than the entire stock market of Germany, the world's 4th biggest economy. That's not rational pricing. That's AI euphoria, eerily similar to the Internet mania of 1999. Yes, AI will change everything, just as the Internet eventually did. But investors forgot the timing in 1999, and they're forgetting it again now. The second bubble is real estate, and its scale is even bigger than the housing boom that detonated in 2008. As of late 2025, home prices sit roughly 50% above their historical trend relative to incomes and rents. At the peak of 2008, we were at 35%. Today's bubble is roughly 43% larger than the one that almost broke global capitalism. And it's not only homes. Commercial real estate is unraveling in slow motion. Office towers across the U.S. sit nearly half empty. Cities like San Francisco hover around a 35% office vacancy rate. Those buildings were financed when interest rates were 3%. Now those loans are rolling over at 7 to 9%. The values don't support the new payments. That means defaults, bank losses, and a domino effect that looks exactly like 2008, except this time the bomb is hidden in commercial buildings instead of suburban houses. The third bubble, the one that truly sets 2025 apart, is in bonds. Traditionally, government bonds act as a safe haven. In 1929, they held firm while stocks imploded. In 2008, treasuries rallied when the stock market tanked. In 2025, government debt is collapsing right alongside stocks because the U.S. has issued so much of it that the market can't absorb the supply. Federal debt is above $36 trillion, 125% of GDP. That's the same debt level America carried after World War II. Except back then, the U.S. stood alone as the undamaged industrial powerhouse of the world. Today, it's competing against nations with healthier balance sheets and stronger fundamentals. Interest on that mountain of debt now exceeds $1.2 trillion a year. That's more than defense, more than Social Security. When interest payments alone swallow your budget, the government is forced into one of three brutal choices: slash spending, raise taxes, or print money. All three lead to recession or inflation, or both. That is the essence of the everything bubble. Stocks stretched beyond reason, real estate inflated beyond 2008 levels, and bonds cracking under unpayable debt. And when you compare 2025 to 1929, the parallels are chilling. In the late 1920s, investors convinced themselves that new technologies, electricity, radio, automobiles, rewrote the rules. This time is different, they said. Today, we're repeating that same mantra with artificial intelligence. In 1929, people borrowed heavily to buy stocks. Margin debt skyrocketed. Ordinary workers chased overnight riches. In 2025, leverage is everywhere. Margin accounts, options trading, credit card-funded investing, corporate borrowing used for stock buybacks. The system is saturated with risk, much of it invisible in complex derivatives and debt structures. Wealth concentration? Even worse today. In 1929, the top 1% controlled about a quarter of total income. In 2025, they hold around 1/3 of total wealth, and the top 10% drive 70% of consumer spending. If their portfolios tank, demand collapses instantly. And unlike 1929, when only 10% of Americans own stocks, today, roughly 58% are exposed through direct holdings or retirement accounts. A market crash now hits more than half the country immediately. There's no buffer. Banking is also more fragile than it appears. Yes, we have FDIC insurance, but the fund has about $125 billion backing roughly $10 trillion in deposits. If multiple major banks fail, the government must print money to cover depositors, and that would torch the dollar's purchasing power. Either way, savers lose. The Federal Reserve once had room to maneuver. In 2008, rates were over 5%, giving the Fed space to cut to zero. They could launch massive quantitative easing. Their balance sheet ballooned from $800 billion to $4 trillion. It worked, temporarily. But in 2025, rates are already relatively low, and the balance sheet is north of $7 trillion. Cutting too fast reignites inflation. Refusing to cut triggers depression. Money printing no longer feels like magic. It's recognized as fuel for inflation. The very tools that saved 2008 are spent. The government's bailout capacity is also maxed out. In 2008, federal debt was manageable at around 76% of GDP, making a $700 billion TARP bailout possible. Today, With debt at 125% of GDP and trillion-dollar deficits, another multi-trillion-dollar rescue would send bond markets into chaos. Globally, the situation is worse too. China, the engine that helped pull the world out of the 2008 recession, is now dealing with its own imploding property sector, massive local government debt, and demographic decline. Europe is grappling with energy instability and political divisions. Cooperation is breaking down. Every nation is preparing to defend itself, not share lifeboats. Now consider the most accurate recession indicator of the last 70 decades, the yield curve inversion. When short-term rates exceed long-term rates, a recession has followed every single time since 1950. The curve inverted in mid-2022 and stayed inverted for more than 2 years before normalizing in late 2024. Historically, recessions begin 3 to 12 months after normalization. That puts us right in the danger zone. Meanwhile, consumers are tapped out. Credit card balances have hit record levels, with interest rates over 21%. Delinquencies are rising fast. Consumer spending accounts for 2/3 of the economy. When borrowing stops, spending stops. Commercial real estate will intensify the blow. Over $2 trillion in commercial mortgages come due in 2025 and 2026. Refinancing at triple the interest rates is financially impossible. Building values have already plunged, leaving regional banks exposed. The bank failures we saw in 2023 were only the tremors. The real quake hasn't hit yet. Even the icons of the market are flashing warning signs. The Magnificent Seven dominate indexes in a way that's never been seen before. Nvidia, alone representing about 7% of the S&P 500, could fall 50 to 70% if earnings disappoint. That single drop would drag the entire market down with it. Insiders know it. Executives across Amazon, Meta, and Nvidia have been selling billions of dollars of their own shares. Historically, insider selling at this scale precedes major crashes. And Warren Buffett? He's sitting on more cash than ever, over $325 billion. He's trimming positions, including Apple, and buying treasury bills. His favorite indicator, the market cap to GDP ratio, is at 185%. He warned that anything above 120% is overheated. Unemployment has begun creeping higher, triggering metrics like the Psalm rule, which has never misidentified a recession start. Auto loan delinquencies are the worst since 2009. Student loan payments have resumed, crushing young workers already burdened with $1.77 trillion in debt. Layer on top global conflict, from Ukraine to the Middle East to the risk of a Taiwan crisis, and you have volatility that rivals the 1970s. Supply shocks to energy or food could spark stagflation. And commercial real estate defaults have already started among big players like Brookfield and Blackstone. If the heavyweights can't make the numbers work, imagine what happens when thousands of smaller owners face refinancing cliffs. The crash itself won't begin with fireworks. It will start quietly. An earnings miss, a bank failure, a geopolitical flare-up, or a debt ceiling showdown. The specific trigger hardly matters. The system is so fragile that any spark will ignite the fuse. The dominoes will fall fast. Major tech stocks drop. Algorithms dump shares. Margin calls accelerate selling. Institutional risk systems kick in, forcing large-scale liquidation. The market could plunge 30 to 40% within weeks. That panic spills into bonds. The government issues more debt to stay afloat. Interest rates spike. Debt service balloons, and the doom loop tightens. Housing freezes. Prices cascade downward. Owners go underwater. Banks absorb losses. More banks fail. And at that point, the illusion of stability collapses. This is the anatomy of the 2025 to 2026 crash. 3 bubbles converging, no tools left to contain the fallout, and a global system stretched to its limits. History doesn't repeat perfectly, but sometimes it rhymes so loudly you can't ignore it.